Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about DILLARD'S Inc. annual report. DILLARD'S Inc. offers a wide range of businesses and services through its retail department stores and online platform. At the core of their operations are fashion apparel and accessories for men, women, and children, as well as cosmetics and home furnishings. In addition to these consumer goods, DILLARD'S also provides an e-commerce platform, dillards.com, where customers can shop online. The company's services extend beyond retail sales, with a focus on general contracting construction activities. This includes constructing and remodeling stores for the company, allowing them to maintain control over their physical locations and ensure a consistent brand image. By offering these various businesses and services, DILLARD'S is able to provide a comprehensive shopping experience for its customers while also managing its own infrastructure and operations. DILLARD'S also operates clearance centers, which offer discounted prices on past season merchandise. This allows the company to clear out inventory and make room for new products, while also providing customers with an opportunity to purchase high-quality items at lower prices. Overall, DILLARD'S diverse range of businesses and services enables it to cater to a broad customer base and maintain its position as a leading retailer in the United States. DILLARD'S Inc. maintains a market capitalization of $9 billion, broadly in line with the industry peer group. DILLARD'S Inc. trades at a lower price-to-earnings ratio of 16 times and a higher price-to-book ratio of 4.99 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 49% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The company has continued buybacks despite weak revenue growth, raising questions about capital allocation priorities. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. Additionally, special charges appear non-recurring, suggesting high earnings quality and strong financial resilience. The primary drivers of revenue growth or decline for a company can be categorized into several key areas. Firstly, retail operations play a significant role, with segments such as cosmetics, ladies' apparel, and men's apparel and accessories contributing to net sales. The construction segment also has an impact, albeit smaller in scale. In addition to these operational factors, the company's investment in its trademark and license portfolio is crucial for revenue growth. Effective merchandising and sales promotion efforts, as well as a private label credit card program with Citibank, can also drive revenue upwards. Marketing and loyalty programs, incentives to customers, and vendor allowances received all contribute to this end. However, there are also several external factors that can influence revenue growth or decline. These include weather conditions, natural disasters, war, public health issues, economic conditions, consumer confidence, and availability of consumer credit. The company's ability to predict and respond to changing fashion trends and customer preferences is also critical in maintaining revenue stability. Furthermore, the protection of brand reputation and customer loyalty is essential for sustained revenue growth. Fluctuations in price and availability of raw materials, fuel, labor, and merchandise can also impact revenue. Overall, a combination of operational and external factors contributes to the company's revenue growth or decline. The net income of the company experienced a decline from fiscal 2024 to fiscal 2025. Specifically, it decreased by $23.3 million, with a net income of $39.6 million in 2025 compared to $63 million in 2024. This decrease was largely due to increased operating expenses, primarily payroll and payroll-related costs, as well as lower retail gross margins. The profit margins also underwent changes during this period. While the consolidated gross margin remained stable at 39.5% for both years, the retail gross margin decreased from 41% in fiscal 2024 to 40.8% in fiscal 2025. This decline in retail gross margin was a significant contributor to the decrease in net income. The reasons behind these changes are multifaceted. In addition to increased operating expenses and lower retail gross margins, the company also experienced a decrease in income from alliances, which fell by $14.5 million from fiscal 2024 to fiscal 2025. Furthermore, potential factors that could impact profit margins include impairment of long-lived assets, changes in tax laws or tax planning, and self-insurance reserve changes. Overall, the decline in net income and profit margins can be attributed to a combination of increased operating expenses, lower retail gross margins, and decreased income from alliances. These factors highlight the need for the company to reassess its operational costs and explore strategies to improve profitability. The company's financial performance indicates a consistent generation of positive operating cash flow over the past 3 fiscal years. The data shows that in fiscal 2025, the company generated $717 million in operating cash flow, followed by $714.1 million in fiscal 2024 and $883,590 in fiscal 2023. This trend suggests a stable financial position for the company, with a steady stream of cash being generated from its operations. The company's debt level has undergone some fluctuations over the past year. Initially, long-term debt increased by $321.7 million on page 37. However, this was followed by a decrease of $16 million from the previous year on page 40. The maturity schedule for long-term debt also shows some changes, with a decrease in 2027 and an increase in 2028. Despite these fluctuations, interest expenses have not shown significant changes overall. The interest rates on unsecured notes range from 7% to 7.75%, indicating stability. However, page 40 mentions that there was a significant change in interest expenses due to amendments made to the revolving credit agreement in June 2023 and March 2025. Management is optimistic about the company's outlook despite operating in a highly competitive market. They believe their stores are in a strong competitive position due to their private label program and e-commerce platform. However, they acknowledge that intense competition could lead to downward pressure on prices, lower demand for products, reduced margins, and loss of market share if they fail to maintain their competitive position. To mitigate these risks, management is focused on accurately predicting fashion trends and customer preferences through strategic initiatives. They aim to grow their private label merchandise program, which comes with additional risks. The company has maintained its gross margin performance in a rapidly changing merchandising environment by prioritizing shareholder return through dividends and share repurchases. Management emphasizes the importance of returning value to shareholders while also investing in strategic initiatives to enhance property values. They plan to continue closing underperforming stores and incur future costs related to store closures when necessary. Overall, management's strategy is centered around maintaining a strong competitive position, predicting fashion trends accurately, and delivering shareholder value through dividends and share repurchases. The acquisitions and divestitures of a company can significantly impact its financial performance and market position. In this case, there are limited instances of both acquisitions and divestitures. Acquisitions refer to the purchase or merger with another company. The only notable acquisition mentioned is the proposed merger with WD Company, Inc., WDC, on March 19, 2026. This indicates that the company is planning to expand its operations through a strategic partnership. On the other hand, divestitures involve the sale of assets or business units. While there are no significant divestitures mentioned, one notable instance is the replacement of the Wells Fargo Alliance with the Citibank Alliance in January 2024. This implies that the company has divested from its partnership with Wells Fargo and entered into a new agreement with Citibank. Overall, the acquisitions and divestitures of this company are limited, suggesting that it may be focusing on organic growth rather than expansion through mergers and acquisitions or strategic partnerships. The company's financial performance is reflected in its dividend payment history and share buyback activities. In terms of dividends, the company has consistently paid out a significant amount each year, with totals reaching $592.6 million in fiscal 2025. This demonstrates a commitment to returning value to shareholders through regular dividend payments. In addition to paying dividends, the company has also engaged in share buybacks, purchasing back shares worth $107.8 million. This suggests that management is confident in the company's financial position and is willing to invest in its own stock to boost shareholder value. The remaining authorization under the share repurchase program indicates that this strategy will continue in the future. Concerns about inventory buildup and supply chain disruption are evident throughout various sections of the report. One of the primary concerns is the potential for supply chain disruptions, which could have a significant impact on business operations if shutdowns or disruptions in distribution or fulfillment centers occur. Additionally, extreme weather conditions or natural disasters can hinder timely delivery of seasonally appropriate merchandise, reduce customer traffic in stores, and increase inventory levels. This can lead to increased costs, lower availability of merchandise, raw materials, fuel, and labor, ultimately affecting cash and working capital needs. The global transportation network is also at risk due to trade restrictions, tariffs, quotas, embargoes, and customs restrictions. Furthermore, geopolitical events such as port congestion caused by weather or other factors can impact supply chains, leading to delayed transit times, longer wait times at transshipment ports, and schedule changes at origin ports. The trend of increasing retail store inventory is also a concern, with a 2% increase in 2025 compared to the previous year. This, combined with inflation and changing trade restrictions, poses a significant risk to operations. Overall, these concerns highlight the need for companies to be proactive in managing their supply chains and inventory levels to mitigate potential disruptions. That concludes the financial summary for Dillard's Inc. Feel free to comment below, and I will be happy to answer them when possible.